Hi everyone! In this video lesson, we are going to be looking at two of the most important factors that a trader should consider before deciding to jump into a stock. Those are the volatility and the liquidity of the stock. Let's start with volatility. As its name implies, volatility indicates the amount of swing that a stock makes within a certain period of time. Now that was a generic layman definition, but in general, volatility can be looked at from two different perspectives. First is the stock's inherent volatility, and second is its relative volatility as compared to other stocks. Okay, so let us start with inherent volatility. Simply put, a stock might have a certain dollar range that it normally moves within on a daily basis. Let's say a stock XYZ normally has a low to high range of 50 cents per day. This could be measured by a metric called the average true range, which is the average range of a stock movement within a certain number of periods. That is usually 14 periods, which could be 14 days or 14 minutes or whatever your chart time frame is. I will not go into details of how ATR is calculated, but you only need to know that it is a number that indicates the normal range that a stock moves within a period of interest. So if the chart period of your choice is the daily chart, and the daily ATR is 50 cents, then you can expect the stock to normally move 50 cents plus or minus within the next day. Now, the stock is moving every day normally and all is great. And then suddenly, some news regarding the stock hit the market. And the catalyst causes the stock price to either rally up or tank down. Either way, it moves outside of its normal range and becomes volatile, meaning it now has a big range with sometimes sharp moves between the highs and the lows. Let us demonstrate that idea through an example. AQXP had a daily ATR of about 50 to 60 cents for several months, and the stock moved steadily in that time period as you can see from the chart. Then suddenly, some catalyst caused the price to rally from about $2 to near $12 in a single day. Then it jumped up to $18 overnight, and the next day it rallied all the way up to $55 before falling back sharply and finishing the day at around $19. See that extreme volatility? In the second day, the stock ran up about $37. Then it slammed right back down $36. Also notice how the value of the ATR jumped from about $0.5 to $5 on the lower curve, indicating extreme volatility at 10 times the normal daily range. It is obvious that the volatility is a double-edged sword. You can make huge gains if you play it right, but you can also lose big if you are careless or get stubborn. In general, volatility is a day trader's best friend, and we develop strategies to trade a volatile stock by capitalizing on the move when it is in our favor and cutting losses quickly if the stock starts to move against us. Okay, so the other volatility concept is the relative volatility. And it is not really a volatility definition, but it simply means that some stocks are generally more volatile than others, even in the absence of any catalysts. This can be judged using the ATR as a percentage of the stock's price. So for example, a $2 stock that has an ATR of $0.3, hence a 15% period range, is 3 times more volatile than a $100 stock that has an ATR of $5 but yields a 5% period range. So you should not look at ATR as an absolute value, but rather as a percentage of the stock price. Okay, so now that we are done with volatility, let us move on to the second topic of this lesson, which is liquidity. Before discussing what liquidity is, let us define the trading volume. It is the number of shares traded during one time period. So it is the number of transactions between buyers and sellers. On the chart, volume is usually represented by the green and red vertical bars below the price chart. By the way, there is a difference in how volume is calculated between the Nasdaq and the New York Stock Exchange. We know that for every share sold, there is a share that is bought. Makes sense, right? A seller is selling their share to a buyer. In the New York Stock Exchange, the volume of this transaction is 1, meaning 1 trade. However, the Nasdaq will count this as 2, and the volume becomes 2. Anyway, this is off topic, And the important thing is that the volume is the number of shares traded during a certain time period, which could be a day, 5 minutes, 1 minute, depending on your time frame. Now let's get back to liquidity, which is closely tied with volume. Liquidity is the ease of getting into and out of a stock without affecting its price. It is obvious that if the volume is very high, then the stock has high liquidity and traders can jump in and out of it easily without affecting the stock price. Let us look at an example. If a stock has a volume of 50,000 shares per day, and a trader wants to buy 10,000 shares, he would be constituting about 20% of the daily volume, and he will significantly move the stock price up because of the high demand he is adding. He will not probably get all the shares he needs at the price he wants, but he might get some at his desired price and the rest at higher price points. Now let's assume the same trader wants to buy 10,000 shares of a stock that trades 50 million shares per day. He would only comprise about 0.02% of the volume, and he will probably get all the shares he needs at his exact desired price, because there will be a lot of sellers willing to sell him the shares for his bidding price. This demonstrates the importance of liquidity, especially when trading bigger share sizes. The more liquid the stock, the better and the easier it is to get in and out at your requested price. And of course, since liquidity comes with volume, we can predict that if a catalyst hits the stock and brings huge volume with it, an illiquid stock will become very liquid during the period of enthusiasm. So liquidity is not set in stone for a particular stock, but rather depends on the stock volume. One thing to note is that liquidity and volatility are different subjects and do not have a direct correlation. A stock can be very volatile, yet it can have either low liquidity or high liquidity. When we have high volatility and high liquidity, we see somewhat smoother and continuous movement through the price range, like for example this chart of pt11 on the left. But on the other hand, when the stock is illiquid and volatile, then the motion is more jumpy and the stock makes stepwise jumps with every tick instead of a continuous smooth motion. This price action can be very frustrating to trade. This can be seen in this example of the intraday stock chart of AGLE. Look at how the price is jumping around and very irregular. Okay, so to conclude, first, the high volatility provides great profit opportunity, but you need to be very disciplined. And second, please avoid trading illiquid stocks as they will be very jumpy and whip you around. We will also see the effect of illiquidity on the spread of the stock price in the next video. Thank you and see you next time.